Wanted to take a look at the stock market. We got some very important economic data this morning, and it is moving the market somewhat. We've seen some up and down. Now, for those of you who caught my video just yesterday, I kind of front ran the number today, and it's doing okay, that particular trade. I want to break that down, but I want to look at SPY stock and sort of do a stock market review so that you can see the breakdown of how this could affect the broader stock market, the economic data we got this morning. Let's jump in. For those of you just joining me for the first time, thanks so much. What I do is I break down the economy and show how that affects the stock market. So if that's something you're looking for, make sure to hit that like and follow button. The comments have been great. The channel is growing quite rapidly. I just broke this off from my original channel, and things are moving forward. We are looking at TLT stock. This is the Treasury Yield ETF. Yields are going to go up higher. They did shoot up somewhat today, and because of that, TLT, which trades off of price on treasuries, fell. Now, since I've put this presentation together, the TLT stock has popped up a little bit higher. But this is basically what I was front running. And as you can see, going from yesterday's price, TLT is much lower than where it was. Again, I bought some puts on TLT and a couple others, just kind of spread it out a little bit, looking for some movements lower. I had two trades on. I bought a much bigger trade on the puts. I put a smaller one on the calls just in case I was wrong. My attitude was basically this: the economy is still moving forward. Treasury yields, which have moved lower since October's highs, too much, too fast, that we'd see a move back upward in treasury yields. And as you can see, just since yesterday, there's been a pretty decent move downward in TLT stock, which coincides with that. Stock market itself. Now, this is a look at SPY stock. SPY stock, of course, is the S&P 500 ETF. We saw a big sort of knee-jerk move lower. We've kind of bounced back upward. And again, SPY stock and the S&P 500 have moved a little bit higher since I put this presentation, and I just checked about 2 seconds ago. Now I wasn't going to put this together. No idea where this will end up by the end of the day, but let's take a look at some of the economic data we got. Here's non-farm payrolls, pretty much kind of where they expected things to be. Now there's something going on with non-farm payrolls that you kind of need to consider when you look at this. There was two strikes: the auto workers and the writers, Hollywood writers. They came back on. So the expectations were that we'd see numbers between, say, 160 and 180. That some of that was those individuals coming back on. But the next two charts I want to kind of break down, we're still trend line moving upwards. So although there was a removal of those individuals from overall employment, they've been put back in. Still, overall, the trend line is up higher. And let's break these down. This is a civilian labor force. So we did see some kind of move lower, but then the civilian labor force has increased. Okay. Number of unemployed has decreased. So we see how the union and the writers are they're back on. So the number of unemployed has decreased. But it's on a number, when you look at the percentages, it's on a number that has increased. There's more people working. So when we look at the unemployment rate, which came in at 4.71, I want to say 4.714. It was previously 4.86 or something like that. So the decrease is 1.5%. Now, if you just looked at the headlines, they round things up. I looked at 3 decimal points. But we saw a 0.15 decline in the unemployment rate overall. More people are working, less are losing their jobs. This isn't exactly what I think the market was looking for. Because of that, this is why we saw the market move. Now, again, we saw the US 10-year Treasury yield, it's popped up. And my thesis remains the same. The yield has fallen since its highs, its peak. The 10-year peaked at 5% in October. It has slid down methodically since then. Thing is, with that move higher in October, I felt it was overblown a little bit. So now moving back downward, getting to a moderate level makes sense, but going beyond that makes not as much sense. This is why I put that trade on yesterday going into today's economic data. You can catch that video that I have up there up on my channel if you haven't seen that yet. The S&P 500. This is what it really kind of breaks down to. And here's the actual index itself. But if you're getting 4.3% yield by giving the United States federal government 10 grand, you're going to get 435% or $430 from that. Your alternate would be stocks. Take a look at the yield. The next 4 quarters you're going to get. Add that up. Divide that over top of the current stock price. What you find is a lot of these companies are yielding less than the 10-year. The 10-year is the benchmark. It's where you start your analysis. For those that don't quite grasp that, I'm tall. But how do we know that to be a fact? Well, we look at the average of the United States of America, which is about 5'10" for males. I'm 6'4". I'm tall. The benchmark, 4.3. Now, take a look at these stocks that are trading on the S&P 500 and ask the question, given the next 4 quarters, what are they yielding? A lot of these stocks are below the benchmark, the 10-year yield. So I still see the S&P 500 being overvalued. Individually, all 500 stocks going forward will be revalued. There's not a lot of incentive for individuals to step in and say, psh, I'm buying. The yield is too low. Your alternative, the benchmark, is much higher. Why would you buy these stocks? So it isn't necessarily that the economy is contracting as much as the information we have now is that the 10-year yield, interest rates in general, are going to remain higher, that the employment numbers we're seeing aren't contracting as fast. In fact, total number employed is higher. And those individuals losing jobs is lower. On a percentage basis, we're now sitting at 3.7%, 3.71 change. That's not exactly what the Federal Reserve is looking for. They will keep interest rates higher for longer. So as an investment opportunity, you're looking at the 10-year benchmark versus stocks. Bonds are the winner. Because of that, stocks are not going to be driven higher. Simultaneously, the Federal Reserve trying to contract the economy by keeping interest rates higher for longer will more than likely have to keep interest rates higher for even longer. Stocks are going to look less attractive. Eventually, the S&P 500 will break to the downside because of valuations. This is how I'm looking at, say, SPY stock. Again, I got in on some puts on TLT stock. Bond yields are moving higher. I have a little bit of theta on there. My options expire next week. They're real close to being in the money on some of the options I've gotten, and 1 or 2 of them are actually in the money. I may just start peeling off a few here and there, locking in some profits and letting the rest ride, because I think next week bond yields move higher. Stocks move lower. It's valuation. The economy, we're still seeing employment gains. So companies are going to get more revenue, but eventually that's going to run out. My thesis remains the same, that towards the end of next year, the Federal Reserve is going to be forced to push interest rates higher and higher because inflation just won't go away. It's going to be a little sticky there. In early November, we've got a presidential election. Fed's not going to want to get in front of that. We'll see how they handle that. We'll see how the economic data plays out. But I think going into 2025, it's going to get ugly. Make sure you hit that like and follow button. We'll see you in the next video.